What do you make of these measures of underemployment that continue to improve?
So it was simply the U6 number that came down. The other broad measures kind of held. So what it meant, it was the part-time for economic reasons that fell. My view, it's probably the case that these are workers that have become discouraged. They've been sitting in the part-time, employment well, could be for years. And maybe they're starting to drop out of the labor force a bit more. We'll see. It's a noisy series. It could very much reverse in the coming months. But that was certainly one thing that stood out to me, is the extent to which part-time for economic reasons did fall.
Tom, what did you wind up making of the rally? You heard Joe talk about the fact that, yeah, okay, we're going to see a rate hike at some point, but it might be pushed out. Was that your take on the markets?
You know, I think the market's been deluged with bad news. We've had an awful month, and yes, and I think this is the first time we've had really bad news and the market rallied big. I think it's a very, very different inflection. I think it's really bullish.
So, the action that we saw today tells you, when we saw this very bad economic news and a really striking comeback, these are the kind of days you look for to get bullish.
Yeah,
basically.
I mean, think about this. If you ask someone on Monday, okay, Friday, there's going to be a huge miss on the jobs report, I think people would have hit the panic button and said we're down 5%. And instead, we had a bad open. The futures collapsed, right? Because we had greens and then collapsed, and then we completely reversed it and actually finished super strong. So I think it's really bullish.
Michelle, I want to go back to something you said, and if we could go, I want to go back into my terminal because you mentioned discouraged workers.
Yeah.
But one thing that I'm having a really hard time squaring in my head is the fact that this survey from earlier in the week shows that the percentage of workers who perceive jobs to be plentiful is surging. This was from the Conference Board Index. So how do we reconcile this rise in discouraged workers and also the number of people say, yeah, there are a lot of jobs out there?
The attempt to reconcile different economic data.
So I'm putting you on the spot because I'm having trouble figuring it out.
It is hard to do, and this is a conversation I've had with a number of clients, which is you look at claims, they're low, you look at the Conference Board measures, they're looking like improvement. So why are you seeing these, weak signs within the labor market?
And it should be noted, we're talking about labor force participation, I think back to 1977.
Yes.
Like
38 years or something like that?
It absolutely is. And if you look at employment to population ratio, you see the same type of thing. So a lot of that is showing the demographic story, and that's going to continue to pull down participation and pull down the labor force. But to your question about why are people saying jobs are plentiful, but yet you're seeing signs of discouraged workers, it could just be, skill mismatch. So certain sectors, there are plentiful jobs. You're seeing job openings very high, but in other areas where maybe more of the workers are and the supply of labor is, you're not seeing as many opportunities. So perhaps it's a dislocation in the labor market.
Well, let's talk about the relationship between the Fed, the jobs, and the market. So global head of rates research at Deutsche Bank, Dominic Kostum, recently wrote that the Fed can never raise rates if the market discounts lower rates. Our confident prediction is that the Fed will raise rates only when the market is begging for it, and it should do it more slowly than the market discounts. What does that look? What would a begging market look like, Tom?
I'd say I agree with the essence of that statement. I think the Fed would want to have sufficient confidence to know that they don't unleash unintended consequences from raising, right? So meaning the market would need to beg for it. But second, that they don't want to be in a position to reverse it, which means I think that the evidence and the economic data has to be overwhelmingly good for the Fed to move.
But having this kind of bullish reversal that you just talked about, that we have this disappointing jobs number, we're down 200 points, we end up in positive territory, is that kind of indication wouldn't be enough then?
Yeah, and I think the rally in the equities is great. What still kind of bothers me a little bit is high yield hasn't really been acting great, so it's not a real confirmation. And I think a lot of folks who are going to be over the weekend are going to be mulling over that dichotomy, right? Because they want to see the confirmation come through in other markets.
And I think it also depends not only on what the markets are saying, but it's really what the data is saying, right? In theory, they should go hand in hand with one another. When the data is strong, you should see solid improvement in the markets. But I think from the Fed's perspective, they need to feel reasonably confident that inflation's picking up. So current inflation numbers have to look pretty decent, and some of these transitory factors that are holding back inflation need to abate.
Michelle, speaking of inflation, average hourly earnings, wage inflation, is like we're having a million of these boy who cried wolf moments. Everybody sees it coming right around the corner. It never comes. What's it going to take When will it happen? When will we get those numbers that actually show, okay, this is real?
So if you simply look at Slack models, so where we are in terms of unemployment relative to NAVRU, or that steady state unemployment rate, we should be on the verge of wage inflation. I think that's why people keep saying it's going to happen, it's going to happen. But instead, we just keep revising down our forecast for NARU because we haven't yet seen wage inflation. So it is a bit of a puzzle. I think conditions are being met, and you're hearing a lot of anecdotes, so it should start to turn higher. I think the challenge for aggregate inflation, though, is are we seeing enough of the push from wages that offsets the deflation from abroad?
Oh, that's an interesting point, which kind of brings us to the dollar and the impact here on the economy. So the question is, we've had a strong dollar for a while, right? We've had emerging markets slowing for a while. So why is it that we're just feeling the impact in the August and September jobs report, meaning that are there other factors at play?
Well, goods-producing jobs were weak, but you're exactly right, Alex. We've been seeing weak.
I stole that from Torsten's Lock, by the way, of Deutsche.
Okay.
It wasn't for me.
but then Thorsten's right. I mean, goods-producing jobs have been falling now for some time. So the mining sector, manufacturing has been weak. That's not new. What was new in today's report and last month's report is that private services producing jobs were weak. So is that just a temporary weakness, or is there something a bit more persistent? So we'll have to see what the next few months show.
Tom, as you look forward to earnings season, how does the strong dollar play into what you're seeing?
Fire Apps had a really great quantification of the dollar impact this year. They looked at 800 companies, and the effect on an annualized basis is $85 billion taken out of bottom line earnings this year. But that's through 2Q. 3Q is even bigger. I mean, third quarter is going to be the biggest. So I think the dollar has actually, just chopped off about $10 out of S&P profits. But if the dollar stays here, by the middle of next year, half of it comes back. So I think, in a way, earnings is actually going to look like we're sort of on peak fear of dollar. It starts to become a tailwind. And
you've talked about how the dollar impact is going to fade fairly soon, right?
Depending, of course, on what you assume.
Measuring it for GDP drag,
yes.
We're not. I think in terms of overall economic growth, you expect it to run the dollar impact.
Precisely, that's right. I think the peak hit from the dollar happened this summer. It will continue to be a drag into the end of the year and probably into early next year. But if you have some stabilization from here, it actually could start to be a bit of a positive because you have the reversal.